For more on today's market movements, as well as the fact that we are at the beginning of the last quarter of the year, we're now joined by Diana Avigdor. She's a portfolio manager and head of trading at Barometer Capital Management. Diana, good to see you.
Thank you very much.
You know, I was surprised. I was getting ready to come on set, and here you arrived, and I wasn't expecting to see you on set, and you're telling me it essentially is telling us it's because the volumes are so light.
Anytime I'm here in person, it's either something very big is happening or volumes are very light. And you started by saying it is very light for some big catalysts coming forward.
Yeah, so what are you sensing in terms of when you look at the markets, you look at the volumes, you look at what people are doing, whether they're putting option trades on to protect portfolios or maybe buying calls? I'm not sure.
So,
what are you seeing?
you know, I wasn't, you just brought something up, options. We weren't meant to talk about options, but option volume in the market, generally speaking, over the last 5 years has been the biggest growth area. Actually. So there's lots of derivative stuff that go on the options. And, you know, while we're on it, we might talk about it, it's partially why the spikes in volatility are occurring also. There's a lot of quantitative trading now, and the discretionary portfolio managers are very you look at confidence numbers, for example, and you see that confidence numbers, any kind of confident number, well, we saw the data last week, the ISM, the AAII investor surveys, they're all very low, and yet markets are at highs. So the discretionary portfolio manager is not that invested, and the way they play things, people play things now a lot, is on the options. But any of these catalysts that we're looking at over the next week or two have the possibility to create binary outcomes.
Which has been the way, I mean, that's been the way, I feel like that's been the way the market's been trading for years now, well,
you've seen,
for a number of years.
You've seen big spikes in volatility, especially lately, as it relates to more and more trade talk, more and more, you know, you have impeachment, you have so many different headlines going on, and yet the market has not really sold off, which kind of makes you scratch your head as to why. So earnings are coming up, and we have FOMC minutes this Wednesday, and the probability of a rate cut over the last 2 weeks has gone from less than 40 to 75, so it's more than doubled based on the economic numbers. So the Fed has truly their work cut out for them.
So how are you focused then? I mean, are you focused, I mean, we all always want to be focused on the fundamentals, but the reality is you got to also be focused on, well, you don't have to, but one style would be to also look at the macro drivers. And where are you spending your time? Yeah,
so, you know, our time, you know, is we are active managers, so we have to do a little bit of both. Our short-term indicators are a little mixed, and they can change fast and hence short-term. But our portfolios are defensive. We have relatively high amount of cash right now. We are about 60-40 U.S. versus Canada, and we have some of our U.S. dollar currency hedged, because as Canadians, that matters. If it was to sell off and we have investments in the U.S., it would hurt those returns.
Let me just stop you there. You think that the U.S. dollar is going to go weaker?
It has not gone weaker, but with rates going down, it should go weaker. But when you compare it relative to the rest of the world, you have seen it very strong, relatively speaking. But the hedge is like an insurance. When you buy insurance on your house, you don't necessarily want something to happen to your house, but should something happen, that would hurt too much. So you isolate the stock return from the currency return, because when you buy a U.S. stock, you have a dual return to that investment. So maybe you neutralize one, and if you chose the right stock, then you're okay with that return, and that's good enough. Because you price back to Canada. We live in Canada. So everything that you do on a daily basis, it's going to price back to Canadian dollar anyway. So you just take out that currency exposure. Not making is not the equivalent of losing. So hedging out the currency exposure doesn't make you win or lose. It's just gone. So you just have your your stock exposure.
How concerned are you about the current earnings environment, and where do you think the street is versus expectations and reality?
Yeah, so, we talked about the sentiment indicators are negative, but the real economic indicators are positive. If you look at employment, if you look at industrial production, if you look at auto sales. So we're looking to earnings to see what kind of narrative we get from the companies. Earnings expectations have come down a lot.
In terms of what? Like, I mean, when we talk about expectations, I mean, that's something to me that's hard to calculate. So are you saying that you've actually seen the earnings per share come down, how much, 5%? What are we talking about here?
There are previews that the street puts out on, and then you take an aggregate of them. And I think that right now earnings expectations are pretty flat year over year. No growth is built in.
Okay.
If you get some growth, that'll be fantastic. If you don't get growth, then it's as expected. Given what's going on out there, given what's going on in the manufacturing data, given what's going on with the trade flows and companies having to reinvent their chains and their supply chains and that sort of thing, this is, I think, going to be a pretty important earnings season. Listening to the companies on the conference calls and the CEOs and the CFOs, what they're really saying about the economy. Because you have sentiment data that's very weak, and you have, like I said, industrial production and employment numbers that are very strong in auto sales. So where is the difference and why? Is it that the headlines are very worrisome, but we don't yet have to do anything about it? Have a GDP number that is off its highs from last year, but it's still growing. We have an employment rate in the U.S. of 3.5%. Canada has had a pretty decent GDP number. Was flat last time, but previous to that was very strong. So there is a mix there that we can hopefully find out from the companies what they say.
Diana, where do you feel most comfortable having money put to work today in Canada as well as the United States? I mean, there is a lot of uncertainty with respect to rates, the fundamentals, the macro picture, the geopolitics. But if we've got viewers at home who might own some utility stocks, and at the same time, too, that might be high valuations, but then where else do you go for returns? Where do you actually feel comfortable in terms of capital management and not losing capital?
Okay, so people really need to think out their risk tolerance and allow themselves for a little bit extra volatility spike. If you absolutely cannot tolerate any drawdown, if you feel that the drawdown will force you into a selling situation that otherwise you would not want to do, then you must move down the volatility curve through utilities and REITs, and we have quite a lot of those.
Okay.
High quality dividend stocks.
Okay.
Stocks that pay you a dividend that will allow you, the investor, the possibility of waiting any kind of volatility out because you get the income from these dividends. 5 to 10% cash, plus minus, some of the accounts are even 15%. That allows us to put money to work should there be a spike down in volatility.
Okay.
I'm pretty emboldened by the fact that the economic data that is real and tangible is strong. I'm positive on the fact that markets have respected technicals, for example. That tells you that some money is being put to work. Even if the discretionary is neutral, there is enough activity out there to hold things. We are quite close to our highs, despite what could have been very negative narratives, but they're being worked through. And the possibility of a spike up should anything positive happen on any of these three fronts, China, U.S. talks, earnings, and rate situation, any positivity, and we could have a volatility spike to the upside. So it's okay to miss the bottom for everyone. Should that happen and there's clarity, it's okay to buy higher on its way to a better price.
Okay, Diana, we'll leave it there. Great to see you. Thank you. That is Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management.